There we go. So I'm Bryan Nunnelley from Crystalline Management. We're a Montreal-based alternative fund manager. We manage the Amethyst Arbitrage Fund, which was launched in 1998, so we are coming up on our 20-year anniversary. There'll be a big party this summer, stay tuned. A little bit about the firm itself. So the firm was the genesis of Marc Amiot, who was at the Caisse de Dépôt as a analyst manager and realized that there was money being left on the table by traditional asset managers. And so he went to the senior management of the Caisse and said, give me a pool of internal capital, there's an opportunity here. And so for 3.5, almost 4 years, he managed those strategies internally, being primarily convertible arbitrage as well as event-driven, being mostly M&A. However, after 3 years, he decided that there was a broader opportunity, and so founded Crystalline Management to be able to offer the strategies to a broader investment group. What have we done over those 19, I'm going to call it 20 years because we're very, very close. I'm pleased to say that we've more or less outperformed every other asset class, long bonds, short bonds, Canadian equities, foreign equities, as well as a peer of hedge fund indices. So we've delivered 8.4% annualized return since inception over that 20 years with relatively low volatility and correlation. How do we do that? We do it with 3 primary strategies. We do convertible securities arbitrage, and I'll give you a quick example of that after. Event-driven, which is primarily M&A, one company buying another. We also do fixed income arbitrage. So these are 3 separate return engines all wrapped up into one strategy offered to investors. We run a highly diversified portfolio, generally around 170 plus arbitrage situations in the fund at any given time. The result is that we have very low volatility and very low correlation with traditional assets. Our asset base is primarily institutional, although we've recently launched some Class A and Class F series for retail investors as well. We do regular due diligence by institutional investors, so we've got a robust infrastructure. What is arbitrage? Pure and simply, it's the exploitation of a spread between 2 related securities. We are non-directional, we don't pay calls on the market, and we generally have very low volatility compared to, we're somewhere between a JP World bond and a Canadian long bond when it comes to our normalized vol. Our return expectation, we're trying to generate 5 to 10% above T-bills with a 5 to 7% vol. Capital preservation is also very key. So what you're seeing here is the general weights between the 3 different asset classes and 3 different strategies. Those vary over time depending on the opportunity set, but it allows us to effectively deploy our capital where we can get the best returns. Convertible securities arbitrage, that tends to be convertible debentures. We can also do synthetic convertible arbitrage, less lately, a lot less warrants in the market, but using options and warrants. Event-driven is primarily M&A, spin-offs, called bonds, and then we also do some fixed income arbitrage, which is focused exclusively on the Canadian market, mostly within the top tier government, provincial municipal agency-backed securities. This is an example of an actual convertible bond arbitrage situation that we put in our portfolio. I'm just going to walk you through it very quickly so you get a little bit of an understanding for what we do. It's a real investment that we put in the portfolio. We still have it today. So in a case like this, a convertible bond will be issued to the market. CALP came out at $100 and it pays a coupon of about 5%. Not bad unto itself, when the underlying equity is trading at about $3.90. So how do we do this? Well, we have to figure out the sensitivity to the convertible bond to its underlying equity. In this case, we use a model that calculates something called the delta that tells us that sensitivity. So our model tells us we need to short 13 shares of CELT in order to put this position on and be relatively market neutral. So we'll buy a debenture for $100, we'll short 13 shares, which means that we get back $50 in cash. So to put that position on for our portfolio, we're only using $49.30 in cash. We still get the full coupon, we'll get a 5% coupon, less our borrow cost. So our return on cash is about 9.6% return. Not too bad, but we can add leverage to that. So by adding a 2 times, 3 times leverage to that, it starts to become an interesting return. We also have to always hedge our positions, so we can generate additional returns by delta hedging. What that means is that as the underlying security moves up and down, the sensitivity to that convertible bond also moves up and down. And so when the equity moves up, the sensitivity moves up, we short more. When it goes down, we buy it back. So we create some additional return. This is kind of the theoretical return framework of each of the 3 strategies. I won't go into all the details, but it gives you a rough idea of the expected return from each of the 3 motors within the portfolio. What I do want to highlight is the risk management. So I mentioned that we do about 170 arbitrage situations in the portfolio at any given time. What that means is it's very diversified. So we use a very simple rule called maximum portfolio total loss, which says that no position in our portfolio can be sized such that it will impact negatively more than 1.5% of P&L. So it forces us to stay diversified, and it forces us to not fall in love with any given situation in the fund. Coming back to the theme of the discussion, I'm just highlighting here some of the return metrics over that 19 years. So what you're seeing is our correlation with traditional bonds. Short, long, world bonds is almost 0. Our correlation with equities is about 0.4. So what we're seeing is, these are kind of the return from the mechanics of the fund, but what we're seeing with our investor base is they're looking for asset classes to replace some of their traditional assets, particularly in the fixed income space where people are concerned about what that's going to yield over the next couple of years, and they're looking for ways to bring additional returns with a very low correlation. And so that's where we're seeing our investor base bring a fund like ours either over top or next to and putting it within the bucket, generally of their fixed income, or if they have a traditional allocation to alternatives, putting in that bucket as well. So that's the Amethyst Arbitrage Fund, and hopefully it'll be less than 10 minutes. Are we going to take questions now, or is what's...
Sure, there are any questions?
Okay. Anybody has any questions?